Hello, folks. This is Brandon Chapman. Today, we're talking about the middle road for the market. So I read an article this morning talking about, the idea of your head in the freezer, you've got your feet in the oven, and your average temperature is 98.6. The idea that we can have extreme views, but somehow that middle ground seems normal. And the reality is that's exactly what the market's taking right now. Is it satisfying for the bulls? Is it satisfying for the bears? As we look at the market today, notice that gold is leading the way with about 10 minutes to go, 1.71%. The S&P is up 0.5%. Technology leading today. Well, what's driving technology? Well, I guess NVIDIA is going to finance another company's purchases of their products and maybe buy it back if they don't need them. The reality is that, look, the market is grinding higher. If we're to look at the S&P 500, we're to kind of measure and look at the range for the market every day in the recent past, for all intents and purposes, it's been wholly unsatisfying. Today's range is about what? About $5.12. The average is $4.98. The first day we've had for a little while that's actually been above average in the range between high and low, or from the previous day's close to the next day's high and low. Well, that's ATR down here. But most all days we've seen over the last recent past have been below average range days. We're not seeing the market go screaming higher with the exception today, and yet the market's going higher and gold is leading it. 1.71%, gold's up today. Why? We're devaluing our currency. Our currency's losing value and gold's going higher and gold stocks are going higher. In fact, Sibanye, Stillwater, SBSW had some significant trade today on the call side of the market here. 5,000 calls bought for January 16, the $15 calls for 16 Jan expiration. But I say, well, who's winning this, right? Who's right? It seems like the bulls are because the market's going higher. And yet, isn't that exactly what the bears are suggesting or the institutions are expecting? As we look at the market grinding higher, we can say the pain trade for institutions is higher, right? This is where we're extracting the most pain to the most moneyed interest in the market. And we know that because why? Well, the remaining hedge, right? The VIX market's going higher, and yet the VIX is also higher today. The VIX is being stubborn here, trading at 16 right now, by the way. Well, shouldn't we be trading at brand new highs? Shouldn't the VIX be trading at new lows? No. The reality is the market remains guarded, and this is also represented in the skew index as well. Skew has remained stubbornly high. Even as the VIX has crept higher, skew has also remained very, very elevated, about 146. Right, this is an end of day data point. We'll get our value for tomorrow. But with the VIX remaining high, skew's still sticking around 150. We're not seeing skew come off, meaning what? They're buying puts and selling calls. That's called a hedge. So who's right in this analysis? Skew's suggesting that what? The downside risks are very, very elevated, right? The VIX is remaining high because they're buying protection in case the market declines. But there's another side to skew. Skew suggests that yes, that downside, that big move to the downside is elevated relative to what? Relative to a normal distribution. The crash risk is there, but this does not time anything. There's also another side of skew. When you have negative skew, guess what? Your mean gets shifted to the downside because we're factoring in those outlier moves to the downside. Your median, your middle value is found somewhere ahead of or to the right of your mean. Your most frequent or your mode is to the right of your mean and median. So as we translate this back to the S&P 500, isn't skew telling you that this is what's going to happen? The idea, with the exception of today being above average in terms of its range, that the default position for the market is to grind it out to the upside, albeit the S&P is only up 0.5% today. But when you add them all together over the course of the last 3 weeks, it makes a significant move in the market. So we take the low to where we are currently, and it's 5%. We've got a 5% rally in basically 3 weeks. That is, in the aggregate, that's a big move. But individually, the days in between, we're seeing tighter ranges, smaller moves, but we're just seeing a very highly directional move, which is exactly what skew tells you. So while the bulls may take the Pyrrhic victory here and say, no, we're right, the market's going higher, all those large institutions that are hedging the market right now, that's causing skew to remain elevated historically about 150, are basically acknowledging the exact same thing, that yes, you're going to have more up days. Yes, the market's going to grind it out, but the downside risks remain, and they're not willing to give you the downside cheaply, right? They're not willing to give you the upside cheaply, meaning what? The skew's remaining elevated. They're still holding out that the potential movement in the market is not falling back to prior points like last December. On a day where the market's up 0.5%, the VIX is up 0.5 point to 16. What we're seeing right now from the volatility markets is that we actually do have a retail trade that is very, very highly bullish on the market. We have an institutional trade that's very guarded and hedged and concerned about the downside. And the squeeze to the upside right now is causing pain, right? To those that are short the market, those hedge funds out there that are short the market, generally in stocks in particular. But we look at the sectors. Most all sectors say are underperforming the S&P 500 except for utilities and technology. Well, that's a crazy alliance. Why would you be bullish on utilities and technology on the same day? What we're seeing again is the hot and the cold averaging out to that middle ground that nobody's traveling in. We're only seeing it because it's the middle ground between both extremes in the market. So I got a lot of lines running here. You have a big print? No, we don't. Mark on a close or nothing. Meaningless. But the idea is that this is the middle ground. So the bulls can claim victory, and guess what? So can the bears, right? They can claim victory saying, yes, this is the default position when you have heavy negative skew. The result of those downside hedges do create potential upside to the market. And the fact that the mode is greater than the mean and the median, we're going to have very high frequency of small up days in the market. So the only question becomes, how do you trade in a market like this, where in reality, both are wrong, and we're just traveling down this middle ground as both paths diverge further and further away? The only way to hold, because of the fact we do have significant downside risks, stocks that can go up significantly one day. Well, let's look at IO and Q, for example. A stock that can go from 40 to 70 can also go down 50% in a day. QBTS had a nice rally. I shared in a session I did last week, the two trades down here that kind of preempted this big move. At the same time, a stock that can go down 4.5% a day, but go up how much? Almost 50% in 2 weeks, can also go from a high back here, 10, within 2 days, you're at 3. Can also go down 50% in a day. How do you balance those extremes out? Up 100%, down 50%. Up 70%, up 50%, down 50%. You've got to keep your footprint small. Remain hedged. It's okay to be long, but look to take profits. And in stocks like these, for example, you might want to consider trading spread strategies that give you excellent pricing with very limited risk, upside potential. But when you have the crashes like this, you're only out a small amount, a fixed amount of risk. Why? And why does it make it acceptable? When you come in here, look, you buy out of the money calls and you sell a call further out of the money, you're buying low and you're selling high. It makes these spreads cheap to buy the lower strike and sell the upper strike. That's the way you speculate. How do you own equities in this kind of market? Well, look, if you got stuff like this, you look to take profits into strength, right? But you're trading spreads. You have very small amounts of capital being invested. But what about NVIDIA? Well, what if you own these kind of companies, the Mag 7 companies, for example, which are grinding the upside and outperform the S&P 500. You just better be hedged. And that's exactly what skew tells you right now, right? You're long, but you're hedged. You're buying puts and you're selling calls to reduce your downside exposure at a point where the market is extraordinarily vulnerable right now. So again, the bulls will claim the Pyrrhic victory because the market's rising, and oftentimes with many stuff, divergences are materializing. The bears are, in essence, the institutions that remain hedged, or the hedge funds that are shorting many companies. They will have their day because many of these high flyers can also decline 50% in a day. The market, the downside risks are significantly more elevated relative to the upside. We've gone 5% off the lows. Maybe we go another 5. What's the downside here? 2,000 points or more? That would carry you back to what April's low. So the idea is that you have limited upside, significant downside if things begin to turn, and you have a Fed that's cutting rates right now with gold at all-time highs and gold leading the way and really just representative of the weak dollar policy ultimately masking over gains, because at the end of the day, net of inflation, gold yields nothing, and yet it's outperforming the S&P 500 relatively by a significant amount today, by about 1.2%. Well, folks, that's our video for today. We'll catch you back next week. Again, just the moral of the story is recognize that nobody's right in this market with poor breadth, very divergent views, and we're just taking this middle path that right now may be working for some, but all we're seeing is the downside risk continue to elevate, and the fact that there is significant hedging, it does point to the fact you should experience more frequent up days, and that's exactly what's happening right now. Well, anyway, we'll catch you next week. Thank you.